Imagine you borrow $100 from a friend. You pay him back 50, then 70, then 90. And somehow, you now owe him more than when you started. That is not a riddle. That is not a hypothetical. That is the documented financial reality of at least 47 countries on Earth right now. Countries that have been paying their debts for decades. Countries where children are being born into obligations they had no part in creating. Countries that by every reasonable measure have already paid back what they owe, several times over, and are still falling deeper into the hole. We call this development finance. We call it foreign aid. We call it international investment. What it actually is one of the most elegant economic traps ever constructed. And the most disturbing part is not that it exists. The most disturbing part is how completely normal it looks from the outside. Today, we are going to pull it apart, step by step, number by number. By the end of this video, you will understand why certain countries have been developing for 60 years without actually getting anywhere. And you will never hear the phrase foreign aid the same way again. Here is the number that should be on the front page of every newspaper, but isn't. In 2023, low and middle income countries paid out more money in debt service, principal and interest, to foreign creditors than they received in foreign aid, foreign direct investment, and development finance combined. Let that land. The money flowing out exceeded the money flowing in, net negative, which means the rest of the world is not, in any practical sense, helping these countries. The money is moving in the wrong direction. The World Bank, which is not exactly a radical institution, published this data. It wasn't buried. It was right there in the annual report. And yet the framing we hear every year at G7 summits, at Davos, at UN General Assembly, is some variation of we must do more to help the developing world. The developing world, meanwhile, is helping us. Now, why is this happening? And why has it been happening more or less continuously since the 1960s? To understand that, we need to go back to the moment the trap was built. Because like most elegant traps, this one was designed to look like a gift. After World War II, a new international order was taking shape. The colonial empires were collapsing, or rather being carefully dismantled and reassembled in a different form. Countries across Africa, Asia, and Latin America were gaining formal independence. Flags were raised, anthems were composed, leaders gave speeches about sovereignty and self-determination. And then came the loans. The logic, on the surface, was completely reasonable. These were young nations. They needed roads, ports, hospitals, dams, electrical grids. Building infrastructure requires capital. Capital costs money. If you don't have money, you borrow it. The World Bank was created in 1944, officially to help rebuild Europe after the war. By the 1950s and 60s, it had pivoted to the newly independent nations of the Global South. It was joined by regional development banks, bilateral lenders, private banks flush with petrodollars, and eventually the IMF. And the loans came with something extra. They came with conditions, not just interest rates. Conditions, policy conditions. In exchange for the money, you had to agree to manage your economy in particular ways. Keep inflation low, privatize state industries, open your markets to foreign goods, reduce government spending, maintain a stable exchange rate. These conditions were called structural adjustment. That is the technical term. The human term is something closer to economic handcuffs. And here is where the math starts to get uncomfortable. Let's walk through a real pattern, not a hypothetical. A country. Let's call it country X, which represents a composite of dozens of actual cases, takes out a loan in the 1970s, something like $500 million. The interest rate is variable, tied to international benchmarks. At the time, it seems manageable, maybe 6 or 7%. Then comes 1979. The United States, fighting inflation, raises interest rates dramatically. Suddenly, international borrowing costs spike. Country X's loan interest, which was variable, jumps. The debt that seemed manageable is now crushing. This actually happened. It's called the Third World Debt Crisis. By 1982, Mexico, Brazil, Argentina, and dozens of other nations were simultaneously unable to meet their debt obligations. Not because they had been irresponsible, because the interest rate on a loan they'd already taken had changed due to a decision made in Washington to solve an American problem. So what happened next? The IMF stepped in with more loans to help these countries pay the old loans. The new loans also had conditions that typically involved cutting social spending, health, education, food subsidies, in order to free up cash for debt service. So the countries borrowed to pay debts, then borrowed to pay those debts, then borrowed to pay those debts, each cycle adding a layer of interest, each loan slightly larger than the last. By the late 1990s, Zambia was spending more on debt repayments than on healthcare and education combined. Not a small gap, more. Tanzania was paying out $9 in debt service for every dollar it received in foreign aid. Uganda, one of the world's poorest countries, was allocating over a third of its government revenue to foreign creditors. These are not edge cases. These are the norm. And here is the mechanism underneath all of it, the thing that keeps the trap locked. When a country is in debt distress, it cannot default the way a private company can. Companies go bankrupt, restructure, emerge smaller but functional. Countries can't simply declare bankruptcy and start over. There is no international bankruptcy court. The creditors hold enormous leverage. And the creditor institutions, the IMF, the World Bank, the major Western governments, are also the referees, which means the rules of the game are written by the people who benefit when you keep playing.
Here is the quiet absurdity at the center of this story. The structural adjustment programs that came attached to these loans were designed, in theory, to grow these economies, liberalize, privatize, and open up. The idea being that free markets and foreign investment would drive development. In practice, what often happened was the opposite. When a government is told to privatize its water utility, it sells it to a foreign company. The foreign company raises prices to turn a profit. The profit flows out of the country. What stays behind is a higher water bill and a phone number for a customer service center in another country. When a government is told to cut food subsidies, local farmers lose price support. Cheaper foreign agricultural products flood in, often subsidized by wealthy governments, who, remember, were also telling this country to stop subsidizing things. Local agriculture collapses. The country that was growing its own food is now dependent on food imports, and food imports must be paid for in foreign currency. Foreign currency? You borrow. There's a particular moment from the 1980s in Jamaica that captures this dynamic perfectly. The IMF required Jamaica to reduce tariffs on imported goods as part of a structural adjustment package. One of those goods was powdered milk from the European community. European powdered milk, heavily subsidized by the EC, flooded the Jamaican market at prices local dairy farmers couldn't match. Jamaica's dairy industry collapsed. Jamaica, a country that had been self-sufficient in milk, became an importer. A decade later, they were borrowing money to buy milk and paying interest on that borrowing to the same institutions that had recommended the policy. This is not conspiracy. There is no shadowy meeting where someone decided to impoverish Jamaica. It is something more insidious. It is a system optimized for one kind of efficiency, the efficient movement of money toward existing wealth, operating exactly as designed, while being described as humanitarian. Now, you might say, okay, that's the 1980s. Surely things have changed. And they have. The trap has been upgraded. The original HIPC initiative, Heavily Indebted Poor Countries, was launched in 1996. It was supposed to provide debt relief, and it did, for some countries, partially. But the conditions attached to HIPC relief were themselves structural adjustment, under a different name. Countries had to demonstrate good governance and sound economic management, terms that in practice still meant liberalization and privatization. More importantly, new creditors had entered the picture. Starting in the 2000s, China began lending aggressively to developing nations through the Belt and Road Initiative and related programs. The terms were often better than Western lenders. No governance conditions, faster approval, actual infrastructure built. But the debt was still debt. And as global conditions changed, many of these loans also became unserviceable. Sri Lanka, in 2022, became the most visible example. Debt to multiple creditors, Western, Chinese, private bond markets, became unsustainable when the pandemic gutted tourism revenue,
foreign currency ran dry, and the government couldn't import fuel. Grocery store shelves emptied. Hospitals ran out of medicine. The government collapsed. Sri Lanka was not poor in the traditional sense. It had a functioning middle class, a literacy rate above 90%, a reasonably diversified economy, and yet the debt structure, the architecture of obligations it had been guided into over decades, left it with zero resilience when a shock hit. This is the other dimension of the trap that rarely gets discussed. It's not just about money leaving. It's about what the debt structure does to a country's ability to absorb a crisis.
There is a word economists use for what happens when a system consistently produces the same outcome, regardless of who is in charge. The word is structural, meaning the outcome is baked into the design, not caused by individual decisions. The debt trap is structural. It does not matter whether the leader of country X is corrupt or honest, competent or incompetent, left-wing or right-wing. The math of compound interest, combined with variable rates, combined with commodity-dependent revenues, combined with no sovereign bankruptcy mechanism, combined with conditionality that keeps markets open to creditor nations, that math produces the same outcome regardless, which is why 50 years of regime change, of anti-corruption drives, of new constitutions and new governments and new development plans, has produced so little fundamental change in the debt position of the world's poorest countries. The problem is not the leaders. The problem is the architecture. And the architecture is maintained by people with extraordinary incentives to keep it in place. Private bondholders who earn returns, multilateral institutions whose existence depends on having borrowers, exporting nations whose manufacturers benefit from open markets in debtor countries, consultants who sell structural reform packages, rating agencies who set the terms under which a country can access credit at all. The system is not a conspiracy. It is more dangerous than that. It is a perfectly rational arrangement for everyone inside it that just happens to be catastrophic for everyone outside it.
There have been moments when this system was almost interrupted. In 2005, the G8 canceled $40 billion in debt for the world's poorest nations. It was called the Gleneagles Agreement. It was celebrated as a breakthrough. Within a decade, many of those same countries had borrowed again because they still needed capital, because the underlying conditions that created the need for borrowing had not changed, and because the money to borrow was always available from someone. The debt relief didn't break the cycle. It reset it. So here is the question that this video cannot answer for you. Is it possible to build a world in which capital flows to poor countries without turning into a trap, where investment is not structured as permanent extraction, where a country can absorb a shock without its children losing access to hospitals? Some economists think yes, and have proposed sovereign debt restructuring mechanisms, automatic debt standstills during crises, new international financial architecture. Some think the existing institutions are too captured to reform and need to be replaced. Some think the whole framework of debt-based development finance should be abandoned in favor of grants, or equity investments, or technology transfer. None of these proposals are close to being implemented. In the meantime, as of today, children in Zambia and Pakistan and Ghana and Ecuador are growing up in economies bent at a 45-degree angle toward creditors who are, at this moment, entirely comfortable. And somewhere, right now, a finance minister in a country you've never heard of is signing a new loan agreement because the alternative, not signing it, is worse. He might be right about that. That's the point. The trap doesn't require malice. It doesn't even require awareness. It just requires that the math stays the math, the rules stay the rules, and that we keep calling it development.